So Kevin asked me the other day, he said, let's do a live today. Let's do an emergency broadcast. And I was like, hell yeah, this is great. Great time to do it. So much things have been happening in the last week. I mean, between the tariffs, between Donald Trump, between all these things, it's been one hell of a week. Um, and there's so many things kind of going on, whether it's the dollar.
One hell of a week.
Sorry, that's on me.
Oh, no worries.
My thing is not like. Sorry.
No worries.
Yeah, no, you go ahead. Yeah, it's been a hell of a week.
It's been a hell of a week. Even we got myself talking in echoes. It's all good. But no, it's really been a hell of a week. And when we're looking at this and looking at kind of the U.S. dollar, when we're looking at the commodities, when we're looking at stocks, whatever it is, there's a story to be told. And so, bringing Kevin on to just kind of talk through these things, kind of see what's going on with the dollar, see what's going on with the market, where a lot of questions we got where's the bottom at, like a lot of people want to know where the bottom's at, and that's always the toughest thing to do in this type of environment. Everybody wants to know, is it Black Monday on Monday? Once again, it's a tough thing to say. I think the thing you had to do last week is kind of just get out of a lot of these positions. I think that was the smartest thing to do, is just kind of like, hey, like, if you hit stops, like, you don't need it. A lot of people continue to hit stops and then they continue to try to buy the bottom over and over again. And it's like, no, just walk away. just go to sleep, like take a break, like wait till this thing really bottoms out and then have an understanding of where you're going to get back in. Cause right now you're just taking a guess. So Kevin, starting out with the dollar, where do you think this market's headed? Do you think the dollar has anything to do with it? What are you looking at today?
Yeah, I mean, dollar definitely has something to do with it. And we've seen the dollar kind of push back here aggressively over the last couple of weeks. Now, one thing to kind of keep, a couple of things when you're looking at the dollar, we have to just understand that its relative performance compared to another pair, right? And that makes a very big difference as to like how we're looking at the dollar compared to, let's say, crude oil or whatever, equities, things of that nature here. So the dollar is actually hitting getting close to a critical area of support, sitting at around that 100 level. Now, one thing to just kind of keep in mind, the dollar usually goes down when we do expect Fed rate cuts as well, right? I mean, that's usually something that we do see. The market's pricing in any type of economic weakness compared to maybe some other countries overseas. If you're looking at the EU or what have you, the dollar can also weaken. So what I would say is I'm kind of still looking at that 100 level as that first area of major support here, which kind of aligns with that chart that you kind of have, right? Where that 101, let's say 100, 101 level is very key. Now, if we, for whatever reason, kind of break below that aggressively, I would get a little bit more concerned. Once again, I think the market's going to be pricing in that an economic slowdown can be on the horizon here, and the Fed may have to take action. Now, what's going to be kind of interesting is, Jerome Powell spoke on Friday, and I think he said exactly what we needed to hear. When it comes to Fed policy, the Fed does not have the economic data right now in order to preempt cuts in this market. Could we do 2 maintenance cuts this year? We talked about this early on in the year, right? 2 maintenance cuts, you can make the case for that just to make sure you get liquidity is going to be in the market or what have you. But if he doesn't see inflation subsiding here and knowing these policies that are in place or are going to be put into place here, and the immediate results, and we're seeing this in the sentiment data now, and the hard data, it's starting to be reflected here as well. When you're looking at prices, inflation is going to be elevated, remain sticky. That doesn't really give them the ability to cut. Now, on the other hand, they have a dual mandate: inflation as well as stable prices, as well as the labor market, and making sure we have job stability. And we just had a jobs report, and it wasn't a bad one, right? And actually, we exceeded the street's expectations. The wage component is starting to degrade a little bit, but if you kind of look at it, it's still elevated. So those are the 2 things that they're actually focusing on. And unfortunately, until the job market actually rapidly deteriorates over the next couple of months, like actually the next month or 2, or you see inflation continuing to subside, actually inflation reversing and starting to subside here, I think the Fed's going to be it's going to be very hard justification for them to cut. And I think that's exactly the right tone. I know that the administration wants to see cuts, but it's very hard to cut in this type of environment with this new economic policy trying to be put into place. So that's kind of where I see I would say probably more pressure to the downside to the dollar, and then we'll see how we resolve it around that 101 level, 100, 101 level, if you will. And these other currencies are starting to bottom out and try to make some headway here. You know, we talked about the Canadian dollar a couple of months ago. You know, people were freaking out about it. And it's like, look, we see this in cycles. Every 4 years, we see this type of cycle, and it did. It had a blow off top, and now you're seeing it kind of reverse. Even though you're going to see economic weakness in Canada, you're seeing it now. The unemployment rate just skyrocketed the last report for Canada, but once again, I think this is on a relative basis. And now, you know, I won't say U.S. exceptionalism is now being priced out of the market, but I think that there's a little bit more of uncertainty when it comes to economic policy, and that's going to be reflected in the dollar and potential economic slowing. What do you think, though?
Yeah, when you go back to the dollar, like let's go back to 2020. You know, when you see this type of pressure in the dollar, like people always think it's always great for stocks, and it's like even in 2020 we had that period of time right before the election where the market was just choppy, it was a mess. There's a lot of volatility, and then the election happened, and then the market kind of went the other way. And then once again, the dollar kind of bottomed out shortly after that. So it's just a very tough environment to just go, hey, you know, just one thing I wanted to add on to what you said is, you know, everybody looks at a down dollar as great for stocks always, and it's just not the case. Sometimes there's plenty of periods of time, if you go through history, where a down dollar wasn't great for stocks. You got plenty of time in history where a strong dollar and stocks went up at the same time. Sometimes even the dollar and gold go up at the same time. So it's something that you just don't want to put in a box. And just like Kevin said, when we're looking at this, we're looking at what's going on with the Fed. Are they going to continue to lower rates? Are they going to have enough pressure put on them to lower rates and so on? So I think Kevin's right on that. I think it is headed lower here. And really, we just got to watch that 100 level. It isn't even about, I know that it's going to go lower all year long. It's just, let's watch that level. So let's get to the S&P 500. The question everybody wants to know, Kevin, call the bottom, say the exact number. Let's do it right now.
I am not going to do that. Look, I don't. So there's a couple of charts that I have for the S&P 500 for us to have some perspective, right? So this is the 3-year weekly chart here. We have those lows of those October lows. You can see this trend line to the upside. Have we touched that trend line yet? No, but we have done a lot of damage over the last couple of weeks, and even last month and a half. And what we have to just kind of keep in mind here is that if we are going to go in a bear market, which I think we are, they take time. And I think so many people have gotten used to the COVID situation, right? That's like the biggest thing that people have on their minds right now. Oh, well, COVID, we pulled down, and then we had this V-shaped recovery. Well, in COVID, we also had fiscal spending to be able to support that for that V-shaped recovery. We also had the monetary policy in order to support that. Right now, given where we're at right now, the monetary policy doesn't look like it's going to be able to support for now. Will there be a Fed put? Yes. There always will be a Fed put. We just don't know what level that's going to be. From the fiscal side, do we have a fiscal put? And I don't think we do right now, unfortunately. And so I think that we still have a little bit more room to run to the downside. Now, what I will say is that since we had this aggressive nature in this pullback here, I would not be surprised if we try to have some, once again, another kind of counter trend rally or this bear flag within a primary trend. Get people to kind of step in. Maybe they do think it's the bottom, and then you get selling into strength again. And this is what's been happening. So do you want to catch a falling knife? No. For now, what you want to be able to do, if you do not have to deploy capital, you probably just sit on the sidelines and just wait for that confirmation. And are we at a capitulatory scenario right now? And I think a lot of people have been asking that question. I would say no. Does the candle say, are we seeing capitulation? The candles say that. But what's usually the last thing that comes with any type of bear market or economic slowdown? And that last thing is usually a credit drying up. I want to call it a credit event. I don't want to be that guy, right? I don't want to be that guy. But you start thinking, okay, logically, what is really happening here? We were already overextended when it came to valuations in the S&P 500. We started seeing prices stall out. We had the failed breakout to the upside. You started seeing valuations before even everybody was even freaking out about tariffs. And I think that's one thing that we have to be mindful of. Look, we had a setup that was already overextended before even the tariff. Let's take tariffs out of this. We still had high inflation, right? We still had Doge cuts, aggressive cuts. We still have a lot of things here, right? You know, the commoditization of artificial intelligence, hardware cycles and things of that nature, which is something that's normal. I don't know why people are getting freaked out about that. But the thing is that we were already kind of stretched. So I think that we continue to pull back to the downside here. And we can kind of talk about the reasons why, but we've done a lot of damage. Do I think that there's a lot more room to go to the downside? Maybe, but I think that we're probably 60% of the way already done with a lot of this, unless we do get a major credit event. And where would that kind of reflect itself? You look at high yield credit debt. And right now we are seeing that actually rise to the upside pretty aggressively. And so if you see liquidity there starting to dry up, that's where you get less lending when it comes to financial institutions. Credit availability kind of dries up. Lack of credit availability means lack of economic expansion, right, or support in the market. And that's kind of where you get this domino effect. And then you kind of have the jobs picture, which is usually the last one for the data to show up. That jobs are I won't even say contracting, and then we kind of move forward here. So dollar cost average, we don't know what the bottom is, but from a technical standpoint, it does appear that we have a little bit more of a pullback. And I'll kick it to you, and we have a couple of more charts to kind of give a little bit more perspective as to why I'm kind of coming to that conclusion for now. Do I think we're gonna have a Black Monday event? I don't know. I don't think it's really healthy for us to call those events, because I mean, we already had a Black Thursday and a Black Friday, right? Like, we already had two of them. Like, I mean,
have another, it wouldn't be a big deal, it'd be completely normal.
Yeah. So I wouldn't want to kind of go to that. It would be a little bit more constructive, or I'm of the mind that we might get something coming out of the White House, and they better do this real quick. But they got it. I believe that they're going to do an olive branch. They got to do it right now before the EU tariffs hit, which sounds like the announcement's going to be on Monday, or they'll announce the tariffs on Monday, I guess, vote on Wednesday or what have you.
Yep.
Right. So so I'm looking for maybe a little bit of an olive branch here, but I don't think that we're done by any stretch of the imagination. What do you think?
Yeah, so first off, guys, Kevin's got his tie on a Sunday. If you guys appreciate that, go through, retweet this, share it with people, give it a like, it'll help this get out to people who really need to see it. But I wanted to talk about one thing that you mentioned, which was a liquidity event. This is the thing that, I've been talking about for a while, which is, we have kind of two ways that this market can go. It's either, hey, we go straight back into an inflationary, stagflationary style environment, or we have a credit event, a liquidity event, and we get that liquidity crunch and everything sells off. I really do think that we have seen an everything sell off type of liquidity event in this market. Like, granted, we can't really call it perfectly today, but I will say, going forward, if we continue to see when people start to sell gold in a rough market environment, that usually means that people need cash, and they need cash for whatever, margin calls, whatever it is at the moment. And I think we're kind of seeing that, where everything's just selling off heavily. The commodities held up very well on Thursday. Then next thing on Friday, those all get sold off. The last stage of that is usually when you start to see bonds selling off and everybody just running to dollars. We haven't seen that yet, but a lot of people forget in 2020, the dollar went down at first. A lot of people forget about that. The dollar actually went lower at first, and then it ripped higher. So, it wouldn't be that surprising to see people start to rush into dollars at some point. And that would kind of tell me that this is kind of coming to a close. But at the moment, there's nothing saying I think the dollar's going to rip. There's nothing saying that that's exactly what's happening. So you really have to be patient here. But I do think a liquidity event is just such a smart thing that you brought up here, Kevin, because I think a lot of people don't understand what that means. And really what we're saying is everything can get sold off. There's nothing that's safe in that type of an event. People are all arguing which is doing better. It's the commodities, gold miners. Is it this or that? It's like, no, everything's going to get sold off if that's the event. And I agree with you. This has to kind of come out and be stopped very soon if it is going to stop. and it either has to be by the Fed or it has to be by the United States president, and that's the only two people that probably have any say in this sell-off at the moment. Until somebody steps in, I think it's painful, and don't try to get in the way and just go out there trying to buy the bottom. It's going to be very hard to do.
And the dynamics have changed too. So let's just say, okay, so what I find very interesting is that the narratives continue to shift, right? There's always this explaining away of what's actually happening now. Like, you know, now there's this narrative like, oh, this is like super strategic 4D chess, all of this stuff. And it's kind of like, look, if this is going to be the new structure, you kind of think to yourself, do you actually see a flight to quality to the dollar? I mean, from an institutional standpoint, if I'm a European financial institution and I put money into the dollar when I know that they're basically going to reverse, I won't even call it globalization, but they're going to be reversing the overall norm of this market. I find that to be very hard. And also, I mean, we're using a lot of political capital here fairly quickly. I mean, this is pretty much almost all of it that we're using very quickly. What if we don't get some of these major trade deals? Because like if you kind of look at the tariffs that we put on, I mean they're completely ridiculous when it comes to the calculations of what they're doing, and I think people are sadly mistaken here. Right now, you're having people talking about, oh well, it's because we have a trade deficit and they need to be buying more from us. China has been in a very strong economic contraction since COVID. They can't get out of their way. So if they don't have consumer spend, is our trade deficit going to really like readjust to reflect that? No, they have economic weakness, but we are showing strength. If we're showing strength, we consume more. Same thing with Europe. Same thing when you're looking at, let's say, even South Africa or some of these other countries that have gotten hit. So a trade deficit with a country doesn't automatically mean that they're screwing us over. It just means that we're consuming more than they are. And I think that actually comes at a position of strength, not a position of weakness. Now, There's a way that you can actually readjust that trade deficit and you start seeing it come more in line, right? There's two ways to be able to do it. They buy more, which if economically they can't buy more, how are they going to consume more, right? Unless they really kind of blow out their currency. You can talk about China, you can talk about the EU, Japan, whatever. Or we stop consuming as much. And that is where I find it's an interesting conundrum for these individuals that are like, oh, well, this is strategic 4D. Do we call it a win? Do we call it a win if that trade deficit does decline, but it's declining because we are consuming less? No, that is not a win. That's a recipe.
Well, Kevin, something to talk about here is, we have talked about this over and over again on here, which is the tariffs and the destruction of the tariffs and how rough it would be. All these things we've talked about again and again. You guys can go back through our videos. Kevin has been just hammering on that topic of tariffs being destructive, of the fact that like you also need to take Donald Trump at face value is something that you've said a bunch too. When he says things like, hey, we're going to put on tariffs, hey, we're going to do this, hey, we're going to do that, he usually does. And Kevin and I have traded through the Trump presidency before. This one isn't very different. It just seems a little bit more aggressive this time. Like he doesn't really care at all because guess what? He can't get reelected this time. So he's just going to go on and doing what he's going to do. And also you'll see this happen in first year of presidential cycles. Once the new president gets in, they kind of want to put their stamp on it, say what they did, what they changed, whatever it is. And then they come in and start doing everything very quickly. So that's what we're kind of seeing, and this creates a lot of volatility in the market. That's why if you look at year ones in presidential cycles, you'll see that they're usually very volatile until the end of the year. So I don't doubt that this is going to be one of those periods where it's just a very volatile beginning of the year. Maybe like by the end of summer into fall, we'll start to see some stability in the market. But for the moment, this is historically one of the craziest things I have seen in my career from a president. And then going back, like me knowing history, like going back to the Smoot-Hawley tariffs in 1929, that would be another time that you could say, okay, it was kind of similar, but not even to this degree. Yeah. And that kind of sparked, it was a highly overvalued market in the 1920s, and we had one of the biggest booms in history. and then it sold off. But we're at the same type of valuation levels today, especially in the technology stocks, the big tech stocks. So it doesn't. It could look exactly like that, where we kind of have this massive drawdown unless somebody steps in. And usually the Fed comes to save the day, and people keep talking about the Fed put and all this stuff. But I think that Powell's going to be very steadfast this time and kind of sit in his hands and go, now's the time to wait, get more data. We don't know enough just yet. And, you can have a huge market downturn before he gets enough data because economic data is always lagging. So I think that this is a very critical juncture in the market. And I think the best thing to do is, if you have signals and you're a systematic trader like myself, take the signals. If you're discretionary, I would just sit on your hands and wait for something to be shown to you and an A+ setup to get back into the market.
Yeah. Technically two big gaps on that chart. This is the weekly. We have to keep that in mind. Do gaps get filled? I mean, we will test them at least, right? Eventually, just say it like this. Eventually, over time, every time that we've had a major issue, whether it's economic policy, natural disasters, terrorist attacks, whatever, medical, avian flu, COVID-19. What was that one that people were freaking out in the early 2000s? I'm gonna forget that one.
I forget it too. Somebody write it.
It started with an S, I think.
Yeah.
But was it swine? No, I don't think it was swine flu.
Somebody write it in the chat. I know somebody knows. I know
they know what I'm talking about.
Knows. Nick Thomas knows it.
It was one of those things.
Somebody put anthrax. SARS.
SARS.
Yep,
yeah.
SARS.
Okay.
Good job.
We do come back.
Said that first. Good job.
So, like, at the end of the day, like, will we eventually get there? Go to all-time high? Eventually, we will. We just don't know the timing here. Let's and Eva's watching as well. Eva is a phenomenal person, a phenomenal supporter. And I know we have a couple of questions on the chat here, but let's go to the next chart here, Jason, so we can get a better perspective. So this one is the weekly chart. This is the monthly chart here. And this one I've been harping on for the last 2 months, actually pretty much since those all-time highs. We had this basically a doji candle at the highs here. And the problem that I have, can we go lower? And the answer is yes. How much lower, KG? I'm looking at that 50-month moving average as your key area of support. I have this highlighted. This is over the last 20 years. You can go back farther than that, but it's a little bit distorted. Somebody also put a comment on one of my tweets. Well, what about the log chart? Log chart also tracks with this. Just be mindful of that, right? So if you kind of look at it, what is that MACD doing? We had that MACD cross. I was concerned about the cross before it crossed. It has now crossed. Look at where it's located, though, Jason. And that's what makes this one, from a perspective standpoint, a little bit more concerning. Can we go lower? And the answer is yes, potentially we can. We can have this thing actually do this. I mean, if you go back and look at 2022, what happened when we had that cross? What happened when we had the RSI divergence and breaking below that overbought level on the RSI? We had a pullback. And every single one of these pullback times, I have them highlighted in that yellow on that MACD, those lines there. Every single time we've come back and touched, or at least got within 1% to 2% of the 50-month moving average. For the S&P 500, that's sitting at 46.56. So do we have more downside potentially? Monthly chart says yes. And monthly chart is actually a pretty decent and reliable chart. The longer the time frame, a little bit, the better the technicals, if you will, right? The better the levels to the upside or downside. We're sitting at 50.74 right now. You're looking at 46.56. Once we get to the 50-month moving average, though, then you start saying, okay, are we near a bottom? Historically, we might be. There's a couple of times we have massive blowouts and we go below it. But historically, usually we'll at least go and touch it. That could also be another area where you say, all right, maybe I want to deploy some capital. And one thing to also kind of note when you're looking at this chart, when MACD bottoms out is usually when we already have bottomed out for the equity market. So they're good indicators for us to show a shift in sentiment, but don't use the trough as the ultimate buy signal, because we probably have already started moving higher, and this is a monthly chart, right? So this is going to take some time. This doesn't mean next week we're going to 4,600. Doesn't mean next month we're going to 4,600. It doesn't mean, and that 50-month moving average will move up as time goes on, right? Because the primary trend is up, and that's how moving averages work. So it may not be 4,600. It may be a different number that's a little bit higher. But what I'm trying to say is keep your eye out on that 50-month moving average, wherever that price level resides. Once we touch, that could be a very strong buy zone, at least on a week or 2 week basis, maybe even longer than that. That could be very interesting. Let's go to the next one, because this one also kind of gives you a little bit of perspective for the bulls out there. Well, yeah, obviously this chart's bearish, but for the bulls out there, this is the S&P 500 equal weight. There's also this perception, oh, okay, well, Mag 7's really what dragged us down, right? NVIDIA, but no, that wasn't the case. And actually, the equal weight was already deteriorating before we even broke. We actually severely broke the S&P 500. What's happening with the equal weight for the S&P 500? Now, this goes back to as far as this has been tracked on the TOS platform here. We're already hitting that 50-month moving average. My apologies. On the equal weight, can we go lower? We could, but go back on that chart once again. Is this going to be some massive drawdown? It could happen, but we have already seen a lot of these stocks re-rate pretty aggressively. So I know a lot of the questions are, okay, well, how much can we go lower? We don't know, but follow the trend. But usually and I hate saying generational buying opportunities, I'm not going to be that person, right? But if there are opportunities where you see stocks that actually do pay a dividend yield that completely just get outsized when it comes to the yield, right? If you're talking about an Exxon trading at given an 8%, 10% dividend yield, could it go lower? It could, but like how many times are you going to get ExxonMobil, one of the biggest energy companies in the world that has a lot of infrastructure in place, right? How many times are you going to get an opportunity to get Exxon at an 8 to 10% dividend yield? That's what you start asking yourself. And I think that's the first thing that people should be looking for moving forward. Are you looking at high yield dividend stocks? I've been harping about that for the last month and a half. On a relative basis, they have been outperforming handedly the S&P 500. Can they go down? They can. But usually if you need to deploy capital as an institution and you have to be long, there's a couple of things that you're going to look for. Low beta, meaning low relationship to the broader S&P 500 when it comes to price action, maybe looking for a dividend yield that is out there, right? And then you're also going to be looking at outsized valuations, or when I say outsized, valuations that are completely discounted to, let's say, a 5-year or a 10-year average. Those need to be your criteria to deploy a little bit of capital. Now, low beta is not going to always outperform. We know that. Eventually, the higher beta stocks will catch up and outperform, but that's not usually the first place that institutions go to deploy capital. They usually go defensive, low beta, defensive, yielding. Once they feel the risk appetite's a little bit greater, they'll start looking at mid cap stocks, small cap stocks. They'll deploy a little bit of capital there. They'll look for the traditional Apples of the world, what have you. If this time is different though, because Apple is going to be like, it's going to get hit fundamentally. NVIDIA may get hit fundamentally. Google may get hit. But if you look at mid cap companies, or even some of these small cap industrial companies, not all small cap industrials, those that might be able to weather the storm and maybe have a little bit less exposure when it comes to tariff risk because they're focusing more domestic demand and supply chains. Those could also be ones that actually catch a little bit of a bid. And that's exactly what happened in Trump 1.0. And you brought up, we saw this in Trump 1.0. Look, 80, I would say 80% of the people don't even remember what happened in Trump 1.0 with the trade war, because did we have an impact when it came to equities? We did. But if you were a commodity trader, it was like the worst. It was the worst trading this. And this is exactly kind of that feeling of like, now these equity traders are like, dang, man, like who would have thought? It's like, wait, this is welcome to the rodeo. Like this is what is happening. So keep that in mind here. I would say technically charts still say a little bit more further downside here. But once you get to around that 4,600 level, it becomes interesting. Not saying we can't go lower, but it becomes a little bit interesting, especially if you're a long-term investor.
No, I like this because there's so many things that everybody's looking at and everybody's saying like, hey, it's just the Mag 7. It's like, no, actually the equal weight actually has been going down for a while. Recently, it's outperforming, but that's very recent. and outperforming on the way down too. So it's not showing something that, hey, we want to buy this thing at the moment. Hey, we want to buy everything but big tech. We just want to be out at the moment. And I've been saying this for a while. And if you guys follow my page, out of the United States, I've been talking about that for a long time. And this is definitely a period of time where it's like, okay, it's very apparent now. And a lot of people are going to try to buy a bottom. And so just real quick on that, it's the toughest thing to do in markets is to buy a bottom. The people I talked recently about a guy I traded with who actually was phenomenal at it, but he never bought the bottom. He would always wait for it to bottom out, get some momentum behind it, buy over a 10-day moving average, something. So you have a place to put a stop loss and so on. And that's the smart way to do it. Don't just try to buy it here. Don't try to buy it on Monday if it goes lower. Understand that most of the time when these things happen, it's going to go sideways, it's going to start basing, and then it's going to start to move higher. So you're going to have opportunities. So don't feel like you're missing an opportunity.
When you're saying that, basing or checkbacks too.
Yep. Right. Or come all the way back and bounce right back off of a double bottom, something. There's going to be a bunch of setups going forward. So don't feel like you're missing the move if you're just sitting on cash right now. Just be happy you're not dealing with the stress of not sitting on cash right now.
Yeah, very much. There was a comment, longer term investor looking more towards leaps and things of that nature, right? Okay, the leap trade does get a little bit interesting if you can afford it. And leaps are actually fairly expensive. We're in an IV environment, or the VIX right now sitting at about 45, very expensive. And we'll kind of talk about that backwardation here in a second. But you're looking at a 2.8% implied volatility or implied move for the S&P 500 just on Monday alone, right? That's the daily implied move. You take the VIX divided by 16, that roughly gives you what it is. So leaps, could you look at leaps in this type of environment? You could. Just know that they're going to be expensive. Just know that they're going to be expensive. But if you go out far enough and you go up high enough, it might be a decent little risk reward ratio. And here's the thing. I don't know if that means next year or Jan's. It might be 2 years out, Jan contracts if you want to get exposure and try to deploy capital. But they will be expensive. But know that those longer term options trades can play out pretty decent. I mean, like if you bought last year, at the start of last year, if you went out and bought like the at the money options for a year later, I mean, they printed hand over fist. Now this might be a different market, but that's another way. Let's say you had $100,000, as an example. You had $100,000. You're like, oh, I want to deploy some capital here. You could also say, all right, well, let me just buy a leap. Let me buy something that expires in a year or 2 years and just take a little bit of a shot. So you can still get upside exposure. You still have exposure to the market, but you're not putting up that as much capital as going in and trying to deploy $50,000, $60,000 when you don't know where the bottom is, where you could go in SPY long-term option, and let's say that you buy something that's 5% out of the money to the upside, and let's say it cost you $33 to do it, so $3,300, but you get some upside exposure. I mean, we just had a 10% pullback in 2 days, basically. So that is also something that you could do. Just know that you would be doing that in a high IV environment, so you will have some crush over time, but you are hoping that things do change. Markets kind of settle out. And even if this is a new regime, we'll get through it. Eventually, we will get through this and re-rate. We just don't know when. So the equal weight is actually very interesting, in my opinion. Volatility, once again, blown out. This is actually historic backwardation that we're seeing in the VIX curve right now. If you're looking at spot VIX versus front month VIX futures, blowing out. I mean, it's more than a 4 standard deviation move. And once you start talking about 4 standard, 5 standard deviation moves, we're talking about fractions of a percentage of outlier moves, right? So you start talking about 3 standard deviations. That's what 99.27% of the time we're actually lower when it comes to that backwardation, right? So high implied volatility environment. That is actually one of the signals, though, that, hey, maybe a but maybe the capitulation moment is around the corner. Just be mindful. In 2008, we had a VIX that stayed between, I want to say 40 and 50 for like a month and a half, 2 months. So that also can happen, but that's an exogenous event. And that's an exogenous event that came with credit every single one of these pullbacks that we saw major bull market or bear market trends, usually it's a credit event that leads that. And so are we just starting that credit event? I don't know. High yield spreads, if you're kind of looking at that, kind of signify, okay, something's going on. I have another chart in there, Jason, and I'll kick it back over to you, but I think it's very important. You're looking at credit default swaps for North America. I think it's like it's gonna be like the last one. All right, credit default swaps. If you're looking at North America, there's an index that you can look at here. And usually, once we hit this level, we usually don't reverse and go lower. We usually go higher. So the higher the number, the higher the spread on CDSs, okay, credit default swaps. So you don't want that line to go up. You want that line to go down, right? And so usually when we hit here, we go higher, especially when we have a basing. And the reason why I call that basing out, you can see the basing formations before the spikes higher. So if you're a bear and you kind of look at that technical setup and you say, okay, well, 50-month moving average, that makes sense. Longer term trend line that we looked at on that weekly chart from those October lows, we haven't hit that yet. Can we see credit spreads getting blown out a little bit more? The answer is yes. And if you look on this chart, I don't see a time when it does not blow out more. And the higher that line, I'm trying to make it really simple. The higher that line, the higher volatility is, and usually that also coincides with markets moving lower. So it's not just technical. It's not just like, oh, KG's fear mongering. It's, hey, no, here's a trend. We can see this on the pattern. We can see the pattern here. And the pattern says, hey, we just clipped the level after basing at very historic lows. And usually it re-rates to the upside and we do hit a clip. And usually at the upper end of that purple box, that's actually very conservative at where we do see near-term peaks. We've seen worse events in the past, but I'm just saying that credit default swaps probably will increase as far as the blowout of that pricing lends you a little bit more credence that maybe some more further downside is ready to go. And if you want to make the downside move, I wouldn't just go long puts. I mean, they've been printing, but they're very expensive. You could actually look at doing put spreads to the downside. You could sell in the money call spreads. A lot of people don't talk about that, but that is something that you want to do. And it doesn't mean that you have to have a bearish take. If you have an S&P 500 type of portfolio or you have a broader portfolio, you can also use put spreads in order to hedge that. And if I'm looking at the S&P 500, and we kind of go back to that other chart, that monthly chart, what if you did a put spread that was from here at these current levels all the way down to that 50-month moving average, and you go out 2 months, 3 months, you're a little bit concerned. That could be your hedge as well. So there's a lot of ways that you can kind of structure this. And I'm not saying, buy puts, probably print. I mean, if we go down, you're looking at another, 7%, probably another 7 to 8% to the downside to hit that 50-month moving average. I'd have to calculate it, but that's another way to kind of do it. So,
but to answer another question that was brought up, which is if we're looking at this and going, okay, the VIX is so high, would we buy options today? I don't think I would. I don't think Kevin exactly would today. I think a good idea is if you're waiting for this thing to bottom out a little bit, wait for the VIX to go a little bit lower. You're going to have you're going to pay a better price for most of these options. I think that's a good idea. Once again, same thing with buying puts. Kevin's been talking about this, and I've been talking about the valuations, and mainly saying, the S&P is being so heavily weighted in technology, consumer discretionary, and communications that if these start to fall down, we're going to see a massive pullback in this market because, even if energy is moving up, or even if, consumer staples are moving up, it's not enough to hold up the entire S&P 500 at this point. So, back then was kind of the time to buy puts. So going forward, put that on your book, which is, hey, going forward, if we are in a very low volatility environment and valuations are high and nobody is talking about a crash, that's a great time to start buying some real out of the money put options. I'm sure they were pennies, went all the way to, probably, 20, 30, 40x just the other day. So once again, this is a good time to start to buy these things.
Yeah.
And so go ahead.
I'm sorry. Go ahead.
No, I was just going to say, let's hop into some questions. I got to run in just a few. So so we got a bunch of people came on today. I want to thank you guys for joining us, sharing it. Kevin and I love to put out information like this when we can. I just went through all the Nick said Zima. I was like, when he was talking about Zika, the Zika virus. I was Nick,
Zima was a problem too, right?
That's an old school beer, like like
Yeah.
the Sprite beer one. That's funny. I love Nick. Nick's a great dude. So seeing a lot of headlines about Vietnam, India, Taiwan offering zero tariffs. Thoughts?
Yeah, Vietnam, huge textile producer, right? We saw the impact what we saw with Nike, and honestly, I don't think somebody fact check me on this, but I honestly don't think that Vietnam had a tariff on us at all. I think this is one of those innocent bystanders that just got popped off, like when they didn't even. Then they're kind of like, "Wait, what are we doing?" So I'm pretty sure that they just took an L for like absolutely no reason. So the Vietnam one, okay, I can understand that. India, I would be very shocked. So maybe the news reports and the headlines are true, but India's had a very protectionist policy just in general across the board. I would be very shocked if they actually do reverse that, but anything's possible there. The problem that you actually have is the pharmaceutical tariffs. That's the big one for India. It's not so much everything else. Yes, they have a lot of electronics exposure and things of that nature, but we do not have the infrastructure in place to onshore pharmaceutical production here in the United States. We don't have the mineral resources and infrastructure in place to even get that in-house. So this whole back and forth between China or even back and forth between India really does put that market in a rock and a hard place. And let me tell you, we usually don't stop consuming medical products. When you're talking about, I'm not even talking about the GLP-1s or who cares about all of that? I mean, obviously they're doing a good thing, but who cares about all that? I'm just talking about basic antibiotics, your amoxicillins of the world, things of that nature. Like we don't have that infrastructure in house. So maybe that's going to be interesting. Taiwan, we have to be mindful. We're also a defense power for them. So it's not just economics when it comes to Taiwan. We know that China has pretty much encircled them. They're doing drills. Even though these live fire drills keep getting more aggressive and aggressive, I don't think that's going to happen this year. It seems like it's going to be a 2027 problem, probably for China. Maybe they accelerate that. But Taiwan is going to have to capitulate because, once again, they need a defense here. That is also another reason why you're kind of seeing this maybe about face for Taiwan Semiconductor trying to bring their products over here. Because they know as soon as we get the technology for AI and they don't have full AI chip production, and that's more broaden out, they lose a major lever when it comes to us being able to defend them or wanting to defend them militarily. So keep that in mind. I brought up the leaps. Will leaps crush when vol crushes? Yes. You're buying time, though. Here's the thing. If you are of the belief that eventually this will subside and we will be at an all-time highs the next year or 2 years or so, or what have you, right? The leaps aspect of it is saying, hey, I can take the near-term pain, but I think the longer-term trend is to the upside, and I might be able to get exposure. So yes, vol crush will drop leap prices, but you're hoping that the advance of S&P and the S&P 500, or if you're using NDX, is going to offset that over time. The 505 calls right now for January 2026, 285 days out. That is a leap expiration. Those 505 calls right now are going for, let's say, around $48. So $4,800 for that type of exposure to the upside. Our all-time highs were sitting at, I don't even know for the SPY. I don't follow the SPY like that. But like, what is 606, 620, 613. So if you say, hey, by January next year, we'll hit all-time highs, that thing will print, for the most part, hand over fist. You could go out into the 27s of January at the money, SPY options, going for, let's say, for 505s, 2027s are going for about $68, which actually is really cheap. So once again, that's another one that you got a year and a half, darn near almost 2 years to get upside exposure. That's one thing to look at. You can sell puts to the downside as well if you have that an entry point. You can also take in some premium with this high IV environment. So that would also be one of those items that you can do. Selling puts though, you got to be committed in getting in at that price. So if you do believe that this is going to be some Black Monday and we're going to go into the lost decade, somebody put a comment about that. Could this be a lost decade scenario? And it could. I don't know, right? Could we have a Japan style last decade? I think we would need a little bit more than this.
Yeah, I'd be surprised.
In order to do that. Yeah, I would be a little bit surprised there. So
my only thought on it past that is that, the only bull case I have fundamentally would be the fact that maybe we saw the worst of it. Maybe that was the most shocking thing that could have happened to this market. And that's the only bull case I have at the moment. Either way, as a trader, I don't want to, if you see a weekly red candle that closes near the lows, that is not something you ever want to try to buy. Yeah. like you just don't want to try to buy it. And once again, I'm not talking from like a guy who's trying to just tell you what to do because I read it in a book. I've been trading for a long time. I've made all of these mistakes when I first started trading. I did very dumb things trying to catch bottoms and doing all this crazy stuff. I'm just saying there's nothing wrong with being patient here. You'll watch the best traders always say, yeah, I don't mind buying a little bit higher. Why do they say that? It's because as these things base out, we start to see them move up. You're going to have some better opportunities and understand your risk to reward better. Today, if I just go buy, I don't understand my risk to reward. But hey, guys, I got to run. Kevin, so glad you got to join me today, man. Always miss having you on. Everybody, thanks. Please follow Kevin. And also make sure to retweet this, subscribe to the channel. We put these out as much as we possibly can, and we'll see you guys soon.